This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 443 was produced on August 29th, 2024. I'm Eric Townsend. Macquarie's global head of desk strategy, Viktor Shvets, returns as this week's feature interview guest. We'll discuss everything from central bank policy around the globe and whether it's become politicized, to recession risks, to why there's been no significant repercussions to the yen carry trade unwind, to politics and geopolitics, to commodities, and of course, the U.S. stock market. Patrick has a new video out explaining how Nancy Pelosi uses options to trade markets. But, of course, never on inside information. She wouldn't do that. Patrick will tell you where to find that video in this week's postgame segment.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, August 28th, 2024. The September S&P futures were down 55 basis points, closing at 56.10. The market showing a point of exhaustion after a strong three-week bull run. We'll take a closer look at that chart and the key technical levels to watch in the postgame segment. The U.S. dollar index down 10 basis points to 101.03. The October WTI crude oil contract up 360 basis points to 74.52, bouncing off its lows, but a lot of work for the bulls ahead to try to change this downtrend. We'll take a look at that chart in the postgame, and Eric will have the EIA inventory data. The October RBOB gasoline up 49 basis points, trading at 206. The December gold contract down 39 basis points, trading at 25.37, but still trading along its all-time highs. Copper down 95 basis points, trading at 415, and uranium down 81 basis points, trading at 79.20. And the U.S. 10-year Treasury yield flat week over week at 3.83, consolidating at the lows of the year. The key news to watch this week is the core PCE price index coming out on Friday, and next week we have the Bank of Canada press conference and the U.S. jobs numbers. This week's feature interview guest is Macquarie's global head of desk strategy, Viktor Shvets. Eric and Viktor discuss central bank policy errors, excess capital, geopolitics, and the commodity markets. Eric's interview with Viktor Shvets is coming up as MacroVoices continues right here on MacroVoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Viktor Shvets, global head of desk strategy for Macquarie Capital. Viktor, it's great to get you back on the show. So much we've got to talk about. Let's start with the Federal Reserve, and for that matter, we can expand the conversation to central banks generally. Have they become political? Heavens no, it could never happen in the United States. And have they committed a policy error?
Well, thank you very much for having me. It's always an interesting question. Are central banks political? It's like asking, is any human institution political or not? The answer, they're all political in some form. It's all about the degree of independence that you get, but nobody is truly non-political. So I don't think Federal Reserve or any other central banks are purely technocratic institutions. However, in terms of whether they made a policy error or not, that's an interesting question because, to my mind, the inflation or the problem of inflation was over and done with probably sometime in earlier 2023. That's when I published that Team Transitory has won, and Team Transitory was right all along. Any inflation after that, pretty much globally, was really anomalies, either statistical anomalies or methodological anomalies, but the underlying inflationary pulse arising out of COVID was pretty much over in 2023. So the question is, by waiting all the way into 24, whether central banks have committed a policy error by keeping interest rates above neutral rates. To my mind, they have committed a policy error, but the consequences are not as significant as they used to be. One of the things I keep emphasizing is that we live in a world of excess surplus capital. We've got abundance of capital, not a constrained shortage of capital. Now, that's quite unique. It only occurred in the last 15, 20 years, and it's been increasing ever since, primarily because money supply has been growing so much faster than nominal GDP. And the difference between the two is this excess capital we have. It's very hard to compute, but on a global basis, I think we have at least $500 to $800 trillion of capital, which means anywhere from 5 to 10 times GDP. So when you have excess capital, prices don't work as well because there is excess of that commodity rather than a shortage. Now, that helps. If you commit a policy error, if you keep rates too high, but there is too much capital moving around, that cushions the real economy. The second thing we have that we never had before is really instantaneous risk repricing. Federal Reserve makes one announcement, the answer is automatically on a screen within a split second. So you immediately know where there is a problem. And the third thing we have, once again, we didn't have it before really, is ability of central banks to roll out new policies on a whim, incredibly fast. Think of it this way. Federal Reserve, it took them almost a year to become comfortable with QE. It took them at least a month to understand that we need an emergency repo facility back in 2019. But in 2023, it just took 72 hours in order to create a brand new facility to rescue Silicon Valley Bank and essentially end the regional banking crisis. So if you have too much capital, which we do, in other words, there is no shortage of capital. If you have instantaneous repricing of risk, and if you have policies that are designed for specific problems and can't be rolled out incredibly fast, how can you commit a policy error? And more importantly, if you have committed a policy error, you can unwind it incredibly fast, pretty much in a split second, without really damaging the underlying economy so much. Now, I'm not saying that if you decided that inflation is a real problem and you want to keep, say, policy rates at 5.5 when neutral rates in the US are closer to 3.5. If you keep basis points up for a long period of time, eventually you're going to crash the economy. But why would you do that if inflation is not really a problem and is unlikely to be a problem as you go forward? So to answer your question, are central banks political? I think every human institution in some form is political. Number two, have they kept the interest rates, whether it's Federal Reserve or ECB, too high? The answer is yes, they have. Have they committed a policy error? Yes. Is it going to lead to recession or extremely negative outcomes, either in terms of bankruptcies or bad debts or consumer spending? The answer, no. We're going to end up with a slower growth. We're going to end up with rates eventually reverting back closer to neutral, which in the case of the US will be 3.5%. In the case of Eurozone, it's going to be more like 1.5% to 2%, lower rates, and we're going to get more liquidity. And if you think of liquidity, if you look at Federal Reserve balance sheet, they're down to about $3.2, $3.3 trillion in Treasury securities. If you think of reverse repo, they're down to only about $300 billion. They need to continue to unwind the idea of QT and, in fact, go beyond that and start injecting liquidity. So my view, in the next 18 months, slower growth, but no recession, lower rates, and more liquidity. So from an asset classes point of view and asset prices point of view, what is there not to like? It's almost like a Goldilocks.
Speaking of asset classes, let's talk about the yen carry trade debacle, which was the huge story of a few weeks ago. Oh my gosh, the world, the sky is falling. Then maybe a week later, it seems like everybody forgot about it. Was that the BOJ just reversing policy, or what happened there? And should we still be concerned?
Well, you should always be concerned when a major player like BOJ or Japan changes policy. It always has some impact. But again, if you take my idea of abundance of capital, not shortage of capital, Japan doesn't play quite exactly the same role. So if you take my view of 500, 800 trillion dollars of capital, Japan with a $3 trillion of net international investments, roughly $1 trillion of lending is important, just like petrodollar is important. But they're not as critical as they used to be 15, 20, 25 years ago, because there's many other sources of liquidity around the world. We're now adding more and more securities for every asset that we have. We used to have 1-to-1, then it was 2-to-1, then it was 4-to-1, now that's 5-to-1. All of those securities can be leveraged. So when the Japanese yen debacle started, my critical question was to ask was, do I see contagion? In other words, there's plenty of capital out there for everybody and for everything. But sometimes people get petrified. And they get petrified because incremental liquidity gets withdrawn. And when they get petrified, they stop multiplying liquidity. Banks stop providing overnights to other banks. Other entities stop multiplying. Hedge funds or family offices stop multiplying liquidity. And so the question in those days, in that week, was really, do you see contagion? And the answer is none. If you think of overnight spreads, if you think of the old TED spreads, which is commercial spreads, if you think of high yield market, whether it's triple C or double B or single B, if you think of basis swaps, which is basically what you pay to swap your currency, no matter where I looked, I really didn't see any contagion. So long as contagion did not occur, so long as people did not get petrified, and therefore so long as they didn't stop the liquidity train, then it's just what I call a heart palpitation. It's not a coronary attack. It only becomes coronary attack or a heart attack if actually you do see contagion. And a final thing to say about yen carry trade. As I said, yes, Japan is important, but less important than it used to be. But if in fact disequilibration or this desynchronization of monetary policy between the US and Japan were to go deeper, it's almost inevitable that BOJ and Federal Reserve will intervene. Now, a lot of people say, Victor, how do you know that something bad is not going to happen? We're all looking at the banks, we're all looking at the corporates, but a lot of that money goes into family offices, they go into private capital, they go into places that are not as visible as other banks or corporates are. How do you know that we will not wake up tomorrow and one of them was on the wrong side of that transaction? Well, I don't know. It is possible, but all I'm saying, just like a Silicon Valley bank, a solution, if it's systemic, a solution will come across. So my view of yen trade was, it's a heart palpitation. It is not a heart attack. It's not a coronary, unless and until we actually find contagion. As I said, it was not back on that week or 2 weeks. It's not there today.
Victor, there seems to be a global trend that I'm noticing, and I don't know if it's related or not, so I'd like to ask you to comment, around, I'll call it extreme politics, whether it be something like in the UK, you've now got threats being made by the director of the police, I forget the gentleman's name, saying that even social media posts posted in other countries criticizing UK government policy could lead to extradition requests. In the United States, you've got an extreme political situation with an election underway where, you know, the incumbent candidate has not made any position statement whatsoever. There's been a huge amount of contention around that. In France, you've got the arrest of Pavel Durov and a lot of, it seems like, growing discontentment within the French system. Is this stuff all related? What's going on here? What's driving it?
Well, it's a good question. And actually, in my latest book that I published, The Twilight Before the Storm, I tried to answer this question. Why are people polarized? Why are societies so polarized? Why politics cannot revert back to being a collegial problem-solving institutions? Why society and politics place so much emphasis on purity and so much emphasis on destruction of the house rather than the compromises which inevitably are required if you were to govern? And the answer to me is what I call Fujiwara effect, which is a merger and reinforcement of several hurricanes. Now, the first hurricane to me is the information age, which are picking up speed and have been picking up speed since 1990s. That basically disintermediates both labor and capital. The second hurricane is what we've discussed a second ago, and that's financialization, that we now live in a world of abundance of capital, not in a world of scarcity of capital. And financialization reinforces technological progression, because what you're seeing is that if you are highly financialized, liquidity has to keep on growing forever. If it does, then there is more and more capital available to try out various technologies. So technology is a human spirit, but the speed with which it propagates depends on the availability at the cost of capital. And so one of the things financialization ensures that it's actually there. And so you have this intertwining or reinforcement of those two hurricanes. It's been made even worse by sort of neoliberal policies that we have pursued, which included globalization, fairly destructive in some ways globalization. It included climate change. It included many other things. So as a result of this Fujiwara effect, or a merger of technology, financialization, and neoliberal policies, people within the countries start moving in different directions at different speeds. And races and national minorities or ethnic groups start moving in different directions, different speeds. When that happens, inevitably, domestic polarization increases. And then the countries themselves start moving in different directions at different speeds. That leads you to geopolitical problems that we have. And so to me, that's the heart of the matter. Merger of financialization and technology that is driving all of those polarization issues. But one of the good things, and by the way, that's why I compared our period to 1930s. Rather than a more conventional comparison by everybody to 1970s. But the good news, if you think of Brothers of Italy, if you think of RN in France, if you think of PVV, even at extreme things like AFD in Germany, what we've seen so far is that if the electorate, the people, are not yet mad enough, are not yet crazy enough, are not yet angry enough to magnify the extremes, in order to be allowed to govern, those countries had to eject their worst ideas. So Brothers of Italy no longer talking about exiting EU, exiting Europe, taxing banks, cutting welfare payments. They essentially become social conservatives. But in an economic sense, they're much closer to the same. Pretty much happened in RN in France. If you think of the United States, Republican and Democrats are moving in a similar direction. So Republican Party is ejecting Project 2025. They're not talking about entitlements, or try not to, or procreation rights. In other words, they're trying to move a little bit to the center. And so is Democrats, who are no longer talking about oil and fracking as much as you would have expected Democrats to do. So it's good news, because the more the electorate forces those parties to eject their worst ideas, the closer the economic policies actually are going to be. And why is it critical? Because that's where your central banks come in and everybody else. The further the policies are apart, the greater volatility that central banks will be facing, and the greater problems what the monetary fiscal policy is actually likely to be. So there is a good news in it. At this stage, the electorate is not yet mad enough or angry enough.
Okay, now I really want to key in on when you said not yet. I noticed the inflection in your voice on the word yet was quite telling, suggesting that it's coming. But at the same time, you just a minute ago said that a lot of these policies were kind of moving back to center as the worst ideas had been rejected. So is your outlook that things are calming down, or things are about to get worse? What was the not yet part?
Well, it depends. It depends on the policies we pursue. And again, if I go to my writings and the latest book, basically what I'm saying, there are policies that you can design in order to lower the pressures. When I compare to 1930s, I was saying, look, in 1930s, the choice was not between freedom and slavery. The choice was, how much freedom do I need to sacrifice in order to avoid the most extreme outcomes? And in 1930s, the choice was between communism, fascism, and constrained democracy. All of them try to address the same problem: inequalities, lack of opportunities, lack of possessions, whatever. It's exactly the same problem. And all of them, whether whether you were communist or a fascist in those days, or whether you were New Deal liberal, it doesn't matter. In all cases, it was all about the government. So whether you're communist expanding the government, whether you're fascist expanding the government, whether you're Franklin Delano Roosevelt expanding the government was the answer. The only question was extent to which the government should spread, extent to which its influence should spread, how much free space should be left for people, for private markets, for private businesses. That was a difference. So the communists said, no free space. We're getting rid of property rights. We're getting rid of discussion, no debate, no politics. Okay, that's one answer. But we're promising you fairness, although that wasn't true, but that's what they promised. If you think of fascists, they said, okay, you can keep your property, but we will determine what we're going to do with it. And by the way, we're getting rid of all the politics along the way. And again, we promise you more fair environment and maybe even longer term, faster growth. The genius in many ways of FDR is that he found the middle ground. Yes, some freedoms were lost. Yes, new agencies come up. Yes, the government reach had increased, but political rights were preserved. So most of the freedoms were preserved. Private sector and private space was preserved. We're kind of facing the same environment. The sort of labels might be different. We're no longer talking about fascist or communist, but the idea is the same. How do we essentially reestablish society? How do we stabilize societies? What will be the role of government in those societies? You know, in 1937, they published this book, Planned Societies and Economies, Yesterday, Today, and Tomorrow. And contributions were from Joseph Stalin, from Benito Mussolini, from New Deal economists, from American sociologists. And the interesting thing when you read it, all of them agreed that liberal free market philosophy led to devastating outcomes. And all of them agreed that the government role will increase. The only difference between your Joseph Stalin or Benito Mussolini or New Deal guys was a degree, extent to which. So the question then becomes, as we go forward, the government tentacles are expanding. The government influence is already expanding and has been for a considerable period of time. Societies are already becoming more conservative, just like they were in 1950s with, un-American activities and the rest of it. So societies are becoming more conservative. Societies are now penalizing more aggressively any behavior that is outside acceptable norms, much more so than societies did, 10, 15, 20 years ago. So we're already moving in that direction. So the question is, how far do we need to move for societies to stabilize? Because if societies stabilize, then the yet is not going to come through. And we actually will land straight from 1930s into 1950s and bypass 1940s along the way.
Let's move on to geopolitics, starting with the Gaza-Israel-Iran conflict. Feels like things are heating up. Israel made some statements this week suggesting they're not about to back down anytime soon on their attacks, and there's been some more fighting. Where is this headed? What is the likely outcome?
The way I look at it, there is what I call the ring of fire around the world. And you guarantee that over the next 5-10 years, there will be earthquakes along that line of fire. Where does it run? It runs through the bloodlands of Belarus, Ukraine. It goes into Balkans. It runs through the Middle East and Central Asia. Then it goes up to Himalayas. Then it comes down to South China Sea in Taiwan. And finally, it goes up to Korea. That's where the conflicts will arise. The only question is whether it's a Hamas, Iran, Israel, whether it's Serbia, whether it's Ukraine, whether it's Taiwan, whether it's India, China, and the Himalayas. The only question is, will it be a hot war or a cold war? So some kind of conflicts are inevitable. The question is one of severity, either economically, socially, politically. Because if you think of a hot war where major protagonists confronting each other, that's devastating because that's where the death rates are at least 200, 300 per 100,000 people. You find military spending goes up to 20, 40, 50% of GDP, massive shifts in fiscal spending, massive destruction of GDP. If, however, you have a Cold War that is fought mostly by proxies, mostly on a localized level, not between the major protagonists, the numbers are much lower. So if you think of military spending, instead of 20, 40, 50% of GDP, it tends to be 5 or 6. Instead of killing 200, 300 people per 100,000, it tends to be more like 5 or 6. Instead of destroying 30, 40% of GDP globally, it only limited to certain areas. And then, of course, there was a period of peace dividend from 1990 until, call it around 2010, when defense spending was less than 2% globally. You find deaths in conflicts were less than 1 per 100,000. So we're already somewhere between the Cold War and the peace dividend. So if you think of defense spending globally, we're now spending more on defense than on research and development, for example. U.S. is now spending 3.5, 3.7% of GDP on defense. If you think of deaths in conflict, we're already up to about 3 per 100,000 from less than 1. So we're somewhere in between. Are we going to keep on drifting towards the Cold War era of 1950s, 1970s? I think the answer is yes. Is it going to be a hot conflict like World War II or the Great War? Right now, it seems highly unlikely. So when people say, my God, we've got Houthis, we've got Hamas, but we always had that. If you think of 50s and 60s, how much of that stuff was going on? It just so happened that between 1990 and 2010, people didn't see it. But now we're returning to normality. Much more conflicts globally, far more turbulent than it used to be in the recent past. Now, the key, of course, is whether it displaces globally demand and supply curves for goods, labor, and services and capital. Now, if the answer is no, and in the Cold War of 1956, the answer was no. It's very unpleasant, and it's a horrible tragedies that are occurring. But from a global economic point of view, it actually does not make a significant difference. And so to me, when I look at all of those tragedies that are occurring, I basically say we return back to normal international relations, that the previous 30 years was abnormal. But it doesn't mean that it necessarily significantly dislocates, as I said, either the global flows or the global trade, or even labor, goods, or services markets.
I'm very curious about your comment to the effect that a Cold War was not likely to lead to a hot war escalation. It seems to me, as we bring the Russia-Ukraine conflict into this, and I'll just remind our listeners, you were born in Kiev, Ukraine, so you probably have some strong perspective on this. It seems to me like the conflict has just entered, I'll call it a new chapter, the push of the Ukrainians into the Kursk region. Now we've got an offensive with German tanks rolling into Russian territory for the first time since World War II. There's been a lot of talk that suggests maybe this is going to be what provokes Vladimir Putin to escalate substantially in terms of his attacks, and it seems like that's happening. So how do we reconcile this doesn't lead to a hot war with the fact that it feels to me like the Russia-Ukraine conflict is heating up pretty quickly?
Yeah, I mean, the risks are there, no question about it. Lots of people who say, well, Russia and Ukraine need to negotiate. The problem is there is no basis for negotiation. What Russia wants, Ukraine can never willingly concede. And what Ukraine wants, Russia will never accept. So you need to wait to a point that both of them, either of them or both of them, are exhausted and are at a deadlock. Now, what Ukrainians have done is basically took the leave of, from Israeli wars, for example, in 1967 and 1973, by changing the game and aggressively attacking. Now, could it lead to much more complex warfare? The answer is yes. But one of the things we've learned in the Shvets war, in the Middle East wars of 1960s, 1970s, one of the things we remember from Budapest, Hungary in 1956, from Berlin Wall in 1961, from Berlin Airlift in 1940s, from all of those conflicts that we have experienced, and every time there was a view that this could lead to something horrible, by and large, it didn't. And the reason it didn't is that nobody was prepared to use the ultimate weapons, which in those days and even today And the reason nobody was prepared to do that, because that's the end. That's the end of your country if you actually are going to do it. And so even Joseph Stalin was reluctant to do it. If you think of Mao, he was reluctant to do it. And remember, they were not shrinking violets, either Mao or Joseph Stalin. So to me, when people say that, I just don't buy. Historically, that's not the way it played out. What we're seeing is a chessboard with Ukraine courageously, in my view, and wisely, changing the dynamics on a battle. Because as I said, everybody who talks about negotiations, they just don't understand that Ukraine is fighting for its identity, as it had for about 500-600 years, against Russians, against Poles, against Lithuanians. And the idea that Russia have of itself is not confined to Russian borders. So if you think of Russian identity, Russian language, Russian ethnicity, it has no relationship to the Russian borders or borders of Russian Federation itself. So you've got this irreconcilable difference that Russia views itself differently. And I think Zbigniew Brzezinski was absolutely right to say that without Ukraine, Russia can never be an empire. But with Ukraine, it automatically becomes one. And he said it back in the early 90s. At the same time, actually quite presciently, he was arguing that probably the worst geopolitical outcome to happen in the future will be the coalition of grievances between Russia, China, and Iran. And if you think about it, that was uttered in 1990s when nobody was thinking about that. So he was right on that too. So to answer your question, yes, it's a risk. It's a horrible thing that's happening, but I can't see a basis for negotiations because it is about the soul and the nature of the countries, which you can't negotiate. The only thing you can do is either both sides get exhausted or somehow find at least a temporary compromise, but not a resolution.
Viktor, with respect to the impact of these conflicts on markets, of course, people think first about the oil market. What I'm hearing in terms of chatter this week among oil traders is kind of a dichotomy between two very opposite views. One is, look, OPEC's got so much spare capacity, they're kind of threatening to terminate their cuts and resume producing previous levels, which would, of course, suggest lower prices, potentially substantially lower oil prices to come. And that is counterbalanced by the fact that these geopolitical escalations keep getting more significant. People are getting more and more concerned about a big upward spike in oil prices. So is it one or both of those things or both at once until one happens on top of the other? How do we make sense of the energy markets from here?
I think all of those things are possible. But if you try to be rational about what's likely to happen, to me, and I'm not an oil specialist, but to me, couple of things come to mind. Number one, remember how people were worried about oil and gas and what's going to happen? Europe is going to freeze because Russia, they're not taking Russian gas and they're not taking Russian oil. It's just remarkable how in the space of just less than a year, the trade got redirected. So in other words, Russian oil and gas are still coming onto the market, but it's coming into different countries. It's coming in a different means. Some of it's legal, some of it is not legal, but it's circulating somewhere. So the idea that oil or gas prices will go up because Russia is out of the system was categorically wrong. Then you have a question that we're not actually short of oil. We've got plenty of oil, plenty of gas. It's just we're not using it the way we could be, and some countries are not pumping it the way they could be, which means it all comes down to demand. So if there's plenty of that commodity theoretically available, it comes down to demand. And so one of the things I've been highlighting is that we're globally living in a twilight. Meaning we have no recessions, but we have no strong recoveries. If you don't have a recession, there's nothing to recover from, right? So we're living in a twilight, no bad debts, no horrible stuff, but the growth rates globally tend to get shallower and shallower and shallower. So if you go back a decade or two ago, global growth rates and market prices would have been 4.5%. Then it was 3.5%. Then it was 3. Today, we're barely traveling at about 2.5, 2.7%. And that applies to 2024. That will apply to 25. In my view, it won't be that much different to 2026. So when you are living in a twilight, no collapses, no recoveries, no bad stuff, but no good stuff, you don't actually have a considerable push in terms of demand for oil and other commodities. And the third thing I highlight is China. In my view, China will never again support global growth rates. It will never again support a global commodity complex. And the reason for that simple, that current leadership of China fully understands that 4 cycles that they have done since 2008 have resulted in massive explosion of debt. They've gone from, less than $5 trillion to $65 trillion. It resulted in a significant decline in efficiency of capital utilization. They now need $10 of investment for every dollar of GDP, whereas previously they needed more like 3. It resulted in lower ROEs, return on equities. It used to be, for corporate 20%. Now it's more like 9%. And so they fully understand that they can't do another cycle the way they did over the previous 15 years or so. And so if you don't have a significant reliance on capital intensive stimuli, whether it's infrastructure, whether it's real estate, then you're not going to provide a support for commodities, whether it's iron ore, whether it's copper, whether it's oil. To me, just answering your oil question, I basically say, number one, we've managed to redirect Russia incredibly effectively. As I said, some legal, some illegal, but it's still done. Secondly, we have plenty of stuff to go on. Thirdly, global growth rates are contained in a relatively narrow range, which means demand doesn't really jump. And a final point is China. And the way China consumes commodity is unlikely to be anything like what we saw in the previous 15 years. And by the way, there is no other country in the world today that is able to replace China or step into China's shoes. That probably will be true for at least 10 years, if not longer.
Let's broaden the conversation beyond energy to commodities generally. I noticed copper in particular, the counter-trend rally in copper stalled and failed right on the 50-day moving average. And we ended up trading well below the 200-day moving average, but rallying back up now, just as we're speaking on Tuesday afternoon. We're once again right on the 50-day moving average, which is where the early July rally failed. Are we about to fail again, or has Dr. Copper begun to stage a real recovery here?
Well, I'm not a commodity specialist. I'm not going to put specific prices. That's other people's job. But the way, again, I look at it is, in the case of copper, there is actually long-term underlying demand. Unless we have a much more effective energy conduit than copper, and maybe we're going to invent something, who knows, in the next 5-10 years. But unless we find something else, copper actually has a long-term demand. Unlike oil, for example, or coal, which are really industrial age assets, I describe them as modern-day equivalent of tobacco. We're addicted, but it is tobacco. Copper is not. And so copper has a long-term line of sight, just like lithium has, just like rare earths has, just like nickel has. But it doesn't mean that it's a smooth ride, because what also is important is, number one, economic growth rates, particularly China, for copper and most iron and iron ore, particularly China. Number two, what is important is how we use it. In other words, how much technology can get to a stage that we're using less of it compared to what we're doing today. That in many ways what happened to nickel over the last sort of 18 months, 2 years. And the third area is supply, how quickly supply actually comes along. Not that long ago, we were talking about massive shortage of supply of lithium. That seems like reversed itself reasonably quickly. So my view when I look at commodities, that I'm not a commodity specialist, is to say, yeah, I would be a rich man if every time I got a dime when people said we're running out of commodities. Because every time we haven't. Either we found something else or we found a lot of it. Alternatively, we've used technology differently in order to use that commodity more efficiently.
Let's move on to the U.S. stock market. A lot of people have suggested maybe we're seeing the beginnings of a double top here. We're within about 80 points, at least as we're speaking on Tuesday afternoon. I'm looking at 56.43 on the September E-mini futures contract. That's about 80 points below the July top. Are we going to take out that top to new highs, or is this maybe a double top that's about to reverse lower?
Well, it could in the short term reverse. I mean, the way I look at the US is to say, if I think of earnings per share estimates on the corporate side, US analysts are putting just a little bit too much growth in my view for 2025 and 26. They're looking at about 14, 15% EPS growth rates. That's too high. If in fact the global growth rates were about 2.5%, and if the US were to fall in nominal GDP growth terms from 5 to maybe 4 or less, generating that 15% is not going to be easy. It should really be in high single digits rather than in a low to mid double digits. So that's your potential negative, that you're actually going to get less growth coming through. But on the positive side, risk-free rates are going to be lower. As I said earlier on, the neutral rates in the US, in my view, in real terms, are less than 1%. So that means in nominal terms, they're somewhere around 3.5%. That's 200 basis points less than where Federal Reserve is actually is today as we speak. So risk-free rates will be lower. Now, that leaves you with a risk premium, equity risk premium, to decide what the value will be. Now, equity risk premium today in the US is incredibly low. Even if you adjust for inflation, it's only about 3%. If you don't adjust for inflation, it's like less than 1. That means it's the lowest since .com. Only during .com period, equity risk premium in the United States was lower than that. So there is no capacity to lower risk premium any further. So the question is the extent to which risk premium might actually jump. Now, to me, it will only jump if you have cataclysmic electoral outcomes. Like one of the worst potential electoral outcomes will be inconclusive and disputed elections. That could create massive problems. So the question is, would electoral outcomes do this? The other way to look at it is to say if the underlying economies were much, much weaker than what we expect. I don't think that's likely to happen, but that's your risk. And risk premium clearly is going to go up. The third area is really, if you look at it, it's a question of technology and growth styles, because the SPX is much more weighted by growth styles than any other index. So the question that comes back is technology overvalued? Now, I happen to believe the answer is no, it isn't. But you can debate whether 30 times is overvalued or undervalued. In my view, everything is valued very highly. I mean, even the value in cyclical styles in the US are trading at 16 times forward. Very seldom they trade it at that sort of a level. So long as my view on the technology is right, so long as electoral outcomes are not extreme and economy slows, but there is no recession, probable risk premium will stay fairly flat. Now, that basically means that the SPX should be range bound. That has been my view for the last 12 months, that lower EPS will be compensated by lower risk-free rate with equity risk premium remaining relatively flat. Now, so far, SPX performed better than I thought it would. And the earnings, to be fair, were actually better than I was anticipating. So to me, I'm still in the same game saying, I can't see why SPX will jump to 6,000 or 6,500. And I can see why it should be range bound somewhere in low to mid fives. I can see that. Now, if you take that view, then the question becomes one of rotation of styles. In other words, what will win and what would lose? Now, so long as you don't have strong cyclicality, and so long as you don't have bankruptcies and disasters, there is no need for defensives because there is nothing to defend against because there is no disasters. On the other hand, because cyclicality is weak, there is not enough there for cyclicals in value. So I'm still coming back to sort of the middle ground, which is a quality, sustainable growth thematics. They are more expensive. It's true. Any of those styles will be on average about 25 times forward. But the ROEs are usually, or return on equity, usually over 30%. Cash flow generation is very high, and the balance sheets are good. So I'm still ending up sort of in the same position by arguing that there is no reason for U.S. market to sell off. Limited reason for it to accelerate massively or deaccelerate. But there is a lot of reasons to argue that you might have rotation of styles depending on what people's views are on cyclicality, on growth, on recession, and on problems, opportunities that will arise. If I rule out all the bad stuff and rule out all the good stuff as well, then I sort of left in the middle.
Victor, I can't thank you enough for a terrific interview, but before I let you go, please tell our listeners how they can contact you and follow your work, but particularly about your book, because I think it really relates to a lot of the topics that we've discussed today.
Yes. Thank you for having me. And yeah, absolutely. The book is called The Twilight Before the Storm, From the Fractured 1930s to Today's Crisis Culture. How to Avoid a World on Fire. And what it basically discussed some of the topics we discussed during this conversation. In other words, I think 1930s is the most comparable period to us. And so the book asks questions, are we destined to live through disasters of 1940s? Or can we just go from 1930s straight into 1950s and 60s, which was not a bad era, even though it wasn't liberal by any stretch and was quite constrained. Or to put it the other way, the choice in 1930s was not between liberty, freedom, and slavery. It was about the extent to which you're going to lose your liberty in order to stabilize your society. And the book also refers to specific policies that people will consider, whether it's industrial policies, whether it's funding of R&D and education, whether it's universal basic income, whether it's how you're going to fund the governments, whether it's a Marshall Plan for less developed countries to make sure that immigration does not become an absolute disastrous issue for all the countries. Because one of the ways to look at it is that we might be facing immigration wave larger than either the 3rd, 5th century barbarians in the Roman Empire or 13th, 15th century Mongols and Turks into Russia, Greece, and Turkey. So how do we make sure that the immigration doesn't become a calamity for us? And you can get it from Amazon. In terms of my strategy work, I am a part of Macquarie Group, and clearly if you are a Macquarie Bank customer, then you will be getting that as well.
Patrick Serezna, Nick Galarnik, and I will be back as MacroVoices continues right here at MacroVoices.com.
Now, back to your hosts, Eric Townsend and Patrick Serezna.
Eric, it was great to have Viktor Shvets back on the show. Now joining us again for the post-game segment is Nick Galarnik. Now let's get to that chart deck. Listeners, you're going to find a download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means that you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Victor's picture saying, looking for the downloads. Now, Eric, let's cover crude oil starting with the EIA inventory.
EIA printed a drawdown of 846,000 barrels. That was against expectations of a 3 million barrel drawdown, so a much smaller draw than expected. Cushing, Oklahoma printed a drawdown of 486,000 barrels, and inventory levels at Cushing are really starting to get critical. Now, I should have been a little bit more careful in my language last week when I repeated what people on Twitter were saying about tank bottoms. Now, it's not actually tank bottoms. There's a minimum operating level at Cushing, which is needed in order to support their blending operations and the other things that they do there. So it's not technically tank bottoms. It's virtual tank bottoms, if you will. We're down to that minimal operational level, and fears are growing. That means that we're seeing a resurgence of backwardation in the term structure of WTI. Gasoline drawing down 2.2 million barrels, distillates building 275,000 barrels for a net petroleum drawdown of 2.8 million barrels. U.S. production ticked back down 100,000 barrels to 13.3 million barrels. That's the plateau level that held for quite a few months. We've seen just a couple of weeks where we poked our head up to 13.4. See if we can get to 13.5. As I mentioned in the feature interview, the rub is that on one hand, some analysts expect OPEC Plus might terminate production cuts. That would allow more oil production, and that's definitely bearish prices. The other side of the coin, of course, is that intensifying geopolitical tensions are adding to the geopolitical premium, which is bullish prices. I'm flat crude right now and focused on other markets. For those of you who want to follow this more closely, our good friend Dr. Anas Al-Haji has had some excellent commentary and coverage in recent Substack and Twitter spaces, so I would direct you there for more detailed coverage, particularly around the significance of whether or not OPEC is really about to increase production and how that relates to market expectations and perceptions.
Yeah, Eric, the prevailing trade range on crude oil is still the most dominant. I have page 2, I have that chart of crude. And what you can observe is that over the last 2 years, we've been in an incredibly sideways tight trade range. And neither the bulls nor the bears have been able to prevail as we bounce around like a ping pong through to these different support and resistance levels. At this moment, we are much closer to the bottom end of this range. And I think that it's a fair assumption that there's a floor on oil that should hold somewhere in the $68 to $70 area. But that's pretty much all the bulls can hang on, is that the downside at this stage is going to be likely contained. And at some point, there will be a trade back to the top end of those ranges that emerges. But right now, at least in the tail end of the summer, there seems to be no life in oil just yet. Now, moving on, I want to get Nick involved in the conversation. And Nick, listen, let's talk about that S&P 500. What levels are you watching here?
So right now, spot price on SPX is approximately 55.90, and we have an implied move for that September 20th monthly OPEX of plus minus 140 points. Therefore, the upper implied move is 57.30, which would mark new all-time highs, and the lower implied move is 54.50. Right now, we have key resistance at all-time highs of 56.70 and key support at 5500. I'm inclined to think we see some more chop into that September monthly OPEX, followed by a window of weakness or so. With NVIDIA reporting last night, having strong results, but falling, that tells me that perhaps the top is in the short term.
Yeah, it's interesting you say that. First of all, those that were looking for big volatility, either to the upside or downside on NVIDIA, were sadly disappointed. And it really now puts in play that the next major market move is likely to hinge off of the September jobs number and then going into the first FOMC rate cuts. And so with the market here pinned and not making a big move on this earnings, it's likely that at least until Labor Day, where things will be quiet. And then the first few days going into that jobs number is going to be where all the market setups are going to be. Definitely the idea that the S&P's top is something that I've entertained all along. A double top retest was always in play, but really I think it's going to be the post FOMC period, like you suggested. It's going to really define whether or not the market is in a bigger topping formation or whether the bulls will prevail one more time into the elections. With that said, Nick, with your view that way, what option strategy are you currently using?
So right now, for hedging purposes against my longer portfolio, I'm using butterfly put spreads, 20 points wide approximately, out of the money, where you have incredible asymmetry of risk. Like, for example, you can risk $1.80 or so to make a maximum profit of $18.20. Which is incredible because it's about 1,000% return on the upside. Now, granted, you rarely ever hit that middle point, but if, for example, we see a decline of 2 to 3% in broad markets, and you watch your position go from $1.80 to, for example, $6 or $7, that hedges you out a few percent on your portfolio decline, which is kind of nice, and it costs you very, very little. One other strategy I use pretty often, especially when I'm being more cautious in terms of when there's a weakness in the markets based on seasonality, like the last weeks of September, for example, is I use deep in the money options, usually leaps, so a year forward in the future, to express my overall bullish thesis while having a much, much lower overall exposure to risk. It's kind of a nice strategy to use. And I noticed that you actually posted a video on your YouTube channel discussing this.
Yeah, Nick, I decided to put in a YouTube video discussing the option strategies that Nancy Pelosi uses on numerous occasions to leverage her returns. Now, most traders use long gamma option strategies for convexity and to construct fixed payoff profiles. But she is using the options as an alternative method to margining to control margin risks while creating definable downside risk.
Yeah, it's a very straightforward strategy, and it's interesting how it manages so many different risks that leverage investors and traders are exposed to. And it's kind of surprising that not many of them use it.
Yeah, absolutely. So listeners that want to better understand the strategy Nancy Pelosi uses, just check it out on my YouTube channel, Patrick_Ceresna. You'll also find a link in that Research Roundup email. Now, Nick, let's move on to the NASDAQ, particularly the QQQs. What are the levels now, especially in the post-NVIDIA numbers?
Right now, we have a spot price of approximately 472 on the Qs, and we have an implied move of plus minus 20 points for that September monthly OPEX. Therefore, we have an upper implied move of 492 and a lower implied move of 452. Right now, we have key resistance at all-time highs of 504 and key support just below at 465. As I mentioned prior, NVIDIA had a pretty damn good earning report. However, the stock price has not responded well at all. It's down a few points right now, but that's more of a function, I think, of the high level of options activity on the stock itself. And I think it'll probably pin around this price and then have a move next week after the options expire. I am currently bearish on tech right now overall, and I am using those butterfly put spreads I mentioned previously to hedge myself as well. However, I am bullish on certain names like Palantir, Shopify, AMD, and NVIDIA.
Well, Nick, moving on to page 5 with the volatility index, and it's interesting that the VIX stays at an elevated level. I mean, we spent the entire first half of the year more or less trading at the 15 level and less on the VIX, and here we are going pretty much on a sustained month of trading at the 15 plus handle on the upside of volatility. Yet the market seems pretty calm here on the very short term, but clearly there are some different trigger points in the coming month, whether it's the jobs numbers or the first FOMC rate cut, that could be, triggers for future volatility in the marketplace. Well, how do you size up the VIX here?
So with the VIX at a 16 handle or so, we can expect to see top to bottom intraday ranges on SPX of approximately 1%. And it's interesting because we're seeing this elevated level of the VIX even as the markets go higher. And I think that's attributed largely to two things. One of them is seasonality in a decline in the latter half of September. And the second one is that we have the election coming up in a few months, and that is going to cause a lot of percolation and volatility as uncertainty rises as to who will win the election ultimately. Overall, insurance is not as cheap as it was a few weeks ago, but it is still somewhat cheap if you are hedging S&P 500 correlated portfolios. But it's important to understand that if you're playing the long game, it doesn't really matter. In the grand scheme of things, markets will move, and ultimately quality companies will go to the upside. And moving on to page 6, we have that US dollar index, which is in a decline right now, but perhaps bouncing off a bottom. What are your thoughts here, guys?
The dollar sell-off trend that Louis Vincent Gav predicted here on MacroVoices a few weeks ago is clearly in play. But markets never move in a straight line, and this market feels overdue for at least a dead cat bounce. I doubt it's going to change the primary trend, which is clearly down, but I think a bounce is likely, and it appears that one may have already begun.
Well, a bounce or no bounce, the one thing that is still very dominant is the downtrend in the dollar. And there's a lot of work for the bulls to reverse this chart. I mean, even a rally on the Dixie back to 102 could easily simply be a fib retracement, sending it right back down to retest its lows. Particularly, it's hard to find a cross currency that is in a position to have the US dollar break out against it. The euro's bouncing along major resistance, but that is no different than the dollar bouncing along its lows. The yen has made a meaningful turn, and the pound sterling continues to just rip. And so with the way that the current backdrop is on the cross currencies, a bounce is probably all that the dollar is going to give on the short term. Maybe that will all change as we get past the FOMC meeting in September. But on the short term, I think it's going to be far more of a trade range bound into that next month.
Now, moving on to page 7, we have that gold futures chart. Eric, what are your thoughts here?
I put my gold chart in the deck this week. As you can see, we touched channel resistance last week, and we've been holding right under that R3 resistance line at 25.54 ever since. We're in a raging bull market, and the primary trend is definitely up. But markets never move in straight lines. The slow stochastics are high and wavering, and there's plenty of room for gold to trade $100 lower without invalidating the primary uptrend. If that happens, it's a swing buy for sure. But right now, we're just below those key resistance levels, so it's hard to justify adding to longs here until we give this market some time to consolidate or trade lower for another buy-the-dip opportunity.
Well, Eric, for me, I'm keeping this very simple. Gold remains in a bull trend, higher highs, higher lows, above all of its moving averages. Old dips keep getting bought, and there's upside measured moves that are still measuring all the way up to 2,700 on the upside. With the fact that the dollar has no imminent catalyst for a big reversal, there's every opportunity for this bull trend to continue. And until there's some sort of topping formation or some major news event that changes the trend, I think that you have to respect that the dominant trend is bullishly to the upside and likely to continue.
And moving on to page 8, we have that uranium chart. Eric, what are your thoughts here?
Let's start with the big news from last Friday morning. Kazatomprom, the big state-owned producer in Kazakhstan, issued guidance for 2025 production to fall 5,250 metric tons lower than prior guidance. That's fully 7.5% of global annual production that just got taken out of supply. And that's the reason for the gap up on Friday last week in uranium mining shares. But while the uranium miners gapped up, the metal itself barely moved at all. So the mining shares predictably retraced, closing that gap in many cases. So even a 7.5% reduction in global supply doesn't seem to have much effect on the physical uranium market, despite the fact that the mining shares reacted instantaneously, or at least it hasn't had much effect yet. Because I'll be traveling to the World Nuclear Association conference, I pre-recorded next week's feature interview today with Sachem Cove Partners CIO and fund manager Mike Alkin, one of the most respected experts on the nuclear fuel cycle in the investment community. Mike is even more bullish than I am long-term, and I think you're really going to enjoy next week's feature interview, which will air on the first full day of the WNA conference next Thursday. So be sure not to miss next week's MacroVoices for much more depth on the uranium market and specifically why Mike thinks the fuel buyers are not reacting to the news flow the way most investors would have expected them to. That's coming up on next week's MacroVoices.
Yeah, Eric, that supply chain news did impact the market, but it's interesting that the spot prices of uranium have not really reflected this yet. Certainly some short-term enthusiasm turning up many uranium stocks and the Sprott Physical Uranium Trust. But what will be really interesting to see is in the coming weeks whether or not the bulls follow through, particularly just a simple thing of just breaking the descending trend line and getting above a 50-day moving average would be positive signs that potentially a new accumulation cycle might be beginning. It's very early, and it'll be very interesting to see whether the bulls can follow through. If it does, after a 6 or 7 month correction, you have to believe that a breakout on the upside here could really set in motion a new bull trend. It's certainly one of the kind of chart setups that is worth watching closely here in the coming week. Finally, on page 9, I had the 10-year Treasury yields, and I wanted to just highlight that we've been pinned into that 380 area that's been the year low, and at this stage, it's now going to likely stay in this area right into that jobs number, waiting to see whether or not there's a clue coming as to whether or not the Fed will move 25 or 50 basis points in the September FOMC meeting. And so that's going to be the key to watch. If for whatever reason they appear more dovish and indicating that the conditions in the market are softening, there's every opportunity for yields to even potentially break down towards its 2023 lows near 350, and that will be the thing to watch technically as to whether this 380 support line holds in that post-news period.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
In this week's Research Roundup, you're going to find the transcript for today's interview, as well as the chart book that we just discussed here in the postgame, including the link to the YouTube video that I did on Nancy Pelosi's option strategies. You're going to find this link and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter at Eric S. Townsend. That is Eric spelled with a K. And follow Patrick at Patrick Ceresna. On behalf of Eric Townsend, Patrick Ceresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.